It's a barn burner, the best and worst life insurance.
Yeah, Brian, I am excited about this because one of the things that, it's a necessary evil. It's something that no one gets excited about talking about. Nobody really gets super jazzed about it, but it is so important when it comes to your financial life is making sure that you have the appropriate coverage in place, that you have the appropriate insured interests that are actually insured. And one of those, for most Americans, is life insurance.
Well, yeah, you're trying to figure out, is this a scam? Is this something that I must have? And I'm going to tell you, you need to tune in because this is one of those subjects I'm like, are people going to watch it? But if you have a spouse, if you have children, you need to hear because we're going to spill the tea on all the things you need to know about life insurance.
So one of the big questions we get is, okay, why do we talk about life insurance? Why is it so important? And why does it have such a bad rap? And one of the reasons why it has such a bad rap is because it is one of the most aggressively sold and profitable insurance products out there. So there are a lot of people that have a motivation to maybe recommend products that are not in your best interest. So what we want to do is break down for you, okay, why do I need it? What are the different types and how do I approach making that decision? So Brian, very first question right off the bat is, why do we need life insurance? Why is it something that we even talk about putting in place?
Well, first we need to give some context on something because I want to go ahead and clear the air. Bo, in a former life, you actually sold some life insurance.
I did, yep, 100 years ago.
I worked for a firm that did life insurance, but in the present form, we are fiduciary financial advisors. We do not sell life insurance. And I think it's an important thing to kind of give that background so there is some knowledge there, but our firm does not benefit from actually selling products. So that's why I think it gives some context that could be very helpful, especially on such an important question like why life insurance.
Yeah, so let's talk about what can it do? What are the reasons people get life insurance? Well, it's because mainly at the main surface of it, if there are people that are depending on you for their well-being, for their livelihood, then we would argue there is an insurable need on your life. If you are no longer here to provide, the insurance policy in place is supposed to step in and provide for your loved ones. And the number one thing that we most often think about is if I can't go out to work and create an income to pay the bills, then this life insurance policy will pay out to replace the income that I was earning for those folks that are depending on that income.
That's why I said at the beginning, if you have a spouse, if you have children, you need to pay attention. And by the way, if you're the stay-at-home spouse that helps with raising the kids, you have a tremendous economic value that still is an insurable interest. So you too probably need some life insurance on your life as well.
So in addition to income replacement or replacing a role that someone might play inside the home, it can also serve as a tool and a mechanism to pay off debt. Maybe if your income went away, your spouse would no longer be able to satisfy the mortgage, satisfy the car payments, pay the student loans, whatever that thing is. So life insurance can be a fantastic tool to satisfy any outstanding obligations that you still have on this earth while you're living.
Well, and then the third thing we wanted to make sure we drew attention to was life insurance can be a great way to fulfill the upcoming expenses or needs of loved ones. Think about, if you want to pay for college for the kids and you're worried about what if I left the earth prematurely, it sure be nice if they still got to go to college. If there's some type of funding mechanism that can fulfill the obligations you feel like to your loved ones, this is the thing that you need to be looking into. Now look, there is a scary stat that ties into this, Bo, is that the majority of people do think about this, but there's a large chunk. It's not quite 50%, but as you can see from the slide, 37% of parents with children under 18, meaning they have little ones, don't have life insurance.
Yeah, so we've established that you need life insurance if there are other people that are dependent on your income generating ability, or for stay-at-home spouses for the role that you serve in the household. And yet here almost 40% of folks don't have that in place. And that's dangerous. That's essentially flying or jumping out of a plane without a parachute, because we never know when our last day is going to come. We never know when we're going to breathe our last breath. And the last thing we want to do is have our family not only having to deal with the emotional turmoil, the difficulty of losing a loved one, but also then all of the financial burden that comes along with that. And life insurance is a very effective and cost-effective way to remove that risk from our financial situation.
So we have effectively laid the foundation that the lion's share of folks probably have some type of insurable need.
Yep.
So this leads to the next big question. What type of life insurance should I buy for my family?
Yeah, and so when we think about life insurance, there are really predominantly two types. Even though they get packaged a number of different ways, there are two main types of insurance. The first is just called term insurance, and the second is called permanent insurance. And they sound exactly like what their name suggests. Term life insurance offers pure insurance coverage for a specific period of time, whereas permanent life insurance, the intent behind that is that it will be in place for the remainder of your life. So one is temporal or temporary, that's the term, and one is permanent, planned on being there. When you pass away, the insurance policy will pay out.
Now, I'm going to play devil's advocate because I know if I'm a person that sells life insurance, I'm going to take advantage of this stat I heard that 99% of term life insurance doesn't pay out.
Yeah, it expires.
So aren't we in effect, if 99% of policies that are written that are term-based don't actually get paid out, isn't that just throwing money away, Bo?
Well, I guess technically, yes. If you think about it in that sense, from an ROI sense, yes, I'm spending money on something that I hope I never use, and I hope I never have to capitalize on. And yet, think about like logically how that plays out. Hey, I spent money on this term for 10 years, 15 years, 20 years, and guess what? I didn't die. That's a reason enough to celebrate.
That's actually a good thing.
It's okay to technically throw that money away because it did serve a purpose, even though you didn't receive a benefit from that life insurance.
Well, in a lot of ways, this is where it is somewhat similar to like when you insure items that you own, like a house or a car. I don't actually get frustrated that I didn't have a car accident last year. It's a
super happy
yes,
about
I paid an insurance premium on that, but I'm glad that nobody in my family got in a car accident and actually needed to go replace a vehicle or something like that. So I think you're right about that, but it is one of those things. I want to build this foundation out a little bit more so people understand what they're dealing with. Term, since it's a period certain, because typically you see like 10-year term, meaning the premiums are level for 10 years, 20-year term, 30-year term, they do expire.
Yep.
So that probably means there's going to be a cost component, because if one is permanent and one goes away, how are these things structured from what I got to pay to get the same type of coverage?
All else equal, you'd probably say, no, I want the permanent stuff, right? Like I want to make sure that's there if all else was equal. But unfortunately, all else is not equal, because when you look at the cost of these two types of insurance, they are vastly different. Look at this. Now, we're just looking at a specific type of permanent life insurance called whole life insurance for this example. But look at what the annual rates of this insurance is for a healthy female in excellent health if she wants to have a $500,000 death benefit for a 30-year-old. She can go out and buy a term policy at 30 years old for $188 to have $500,000 of coverage in place. If instead, though, she wanted to go buy that same amount of coverage, but buy a permanent life insurance policy, a whole life policy, she's going to spend over $4,000 a year for the exact same amount of coverage.
No, there's a difference. Typically with a term policy, like on a 30-year-old like this would be for a 20-year level period.
Yep.
Now, look, if you have a child that was just born when this person was like 28 years old, and now by the time this person gets to 50 years of age, that child will probably be graduated college, and hopefully they'll be financially independent. It will be completely fine that this insurance goes away. But I got to tell you, this is the thing that when I see the pricing, because when you look at 30-year-olds, 40-year-olds, it is like a 20-fold difference in what the annual premium. And I just know when I was in the messy middle, I had, it seemed like everything in the world was trying to get to my back pocket. You know, whether the kids, me trying to save for retirement, there's just so many things going on. The fact that if I had to save $4,000 a year to pay my life insurance premium versus $188, I don't think I could do it. So I would just be sitting there naked on the exposure to my family, whereas at least term allows me to cover the need, but then invest some of that money above and beyond that for the future so I can actually build financial independence above and beyond.
Yeah, but see, that's where the salesmen get you. That's where they kind of wrap this up as a different thing. Okay, no, you don't have to just let your life insurance be this thing that you're throwing money away on. It can actually be a wealth generation tool for you. We're going to pitch it as a way where not only can you buy the life insurance covers, but we're going to have those dollars grow. We're going to have those dollars be invested. We're going to have those dollars pay a dividend. But we think, our opinion is, your strategy that you just said makes a lot more sense. We want our insurance products to be insurance. We want our investment products to be investments. Because what we find is when we mix those together and we have them serve a dual purpose, neither of those purposes are optimized, and we think that it's not the best solution. There's a few different reasons why we say that.
Now, wait a minute. I want to stop you because, look, we don't sell life insurance. So I think if I was an insurance professional, I'd be like, well, these guys, they're going to just try to push you towards something that they deal with versus what we deal. But don't take our word for it. Daniel in the notes, and you can do your own research on this. Consumer Reports had an entire write-up on whole life insurance. Mm-hmm. Is it right for you? And you can go do your own Google due diligence on this. But from their findings, they found that this more conservative type of investment or thing that you're buying to provide coverage that we already shown is 20 times the cost of term is only typically providing a rate of return between 1.5% to 3.5% per year on average.
And that's on average after all the fees and all the expenses, because what you often get pitched on, there's this guarantee, there's this dividend rate, there's this rate of return that you're going to receive on this if you're talking specifically about whole life, on this whole life policy. However, one of the things that's really, really interesting is that guaranteed rate of return. You would think, as we've moved into this environment where interest rates have gone up and cash a couple of years ago was paying nothing, but now we're seeing cash paying rates as high as like 4.5%. You would think that the dividend rates on those whole life insurance policies would have been the same. They haven't. They've actually stayed flat or actually decreased slightly. So these dividends, this guaranteed return, doesn't necessarily move with interest rates. So if we do enter into a time period where we have really high inflation, like we've seen over this past couple of years, these policies, often the growth rate that's embedded in them, even if you were getting the full dividend rate, not factoring in the fees and expenses, wouldn't even keep up with higher levels of inflation.
But maybe we're looking at this wrong. Maybe the guaranteed type of product is not right. That's your whole life. What if we transition to maybe a variable life insurance policy? Because there's even products, because these insurance companies, they're no fools. They've actually structured products that actually allow you to have some component to participate in what's going on in the stock market. What's the issues with that?
Yeah, so a lot of times what they'll do is say, okay, great, you can invest these dollars. And then what we're going to do, though, is we're going to put some caps on them, or we're going to make you subscribe to a capture ratio. So maybe if you invest and you are going to, in the market, you want to peg it to some specific market benchmark, rather than you getting all of that uptick, you're only going to get a portion of it. So maybe you're going to have a rate cap. If the market makes 15%, 20% in a given year, you might actually only be capped at 7% rate of return. Well, what do you think that the insurance companies are doing with these dollars? They're taking these dollars and investing the same way as you could on your own, except for they're keeping the amounts above and beyond those rate caps. So they're actually handcuffing what these policies can return over the long term.
Well, what I don't love about life insurance as an investment is you're going to figure out a whole cadre of words like surrender period, a deferral period where you're not actually allowed to pull out more than 10% of the cash value of policies. Just be careful, because there are a lot of restrictions. Because remember, to offer guarantees or even to offer participation in the markets, there has to be a catch.
That's right.
Because they have to control your behavior. And a lot of times the catch on like the withdrawal on the guaranteed products is going to be your inability to pull the money out. So they have enough time to spread out the risk. On the variable products, they're going to catch you on the fine print, like they're going to take away the dividends, the S&P 500. They might show the performance, but they don't get to count the dividends and other participating factors, or they'll cap the performance. So if you have the years, like you shared, where the market makes 20% and you're capped at 7 to 9%, that is tremendous in the long term. So just don't fall prey to this. And this is a challenge that I have. There is no doubt that there are very wealthy families that do use insurance as a tool.
Sure.
However, I am still waiting when we do our annual wealth study of all of our millionaire clients. I don't have any of my millionaires who have said that the reason that they're a millionaire is because of this great insurance product that got them there. It is typically a tool that the ultra wealthy use to kind of expand or protect their wealth. It's not the tool that got them to wealth. That's just my experience. I'm sure there's going to be insurance agents and others that will say it. And I love insurance. If you looked at how I've structured my financial life, I am insured up to my eyeballs. However, it is one of those things where I have not used insurance to try to be the wealth builder because I just don't think that that is the most efficient path with all the fees, all the restrictions. There is a much better way, but that doesn't mean you should ignore what value that life insurance can provide for your family.
Okay, so we've talked about, Brian, why we get life insurance in place. We've talked about the different types of life insurance that you might decide to buy. Let's talk about the third thing. How much do you need? How do you decide, okay, you've told me that I need life insurance and I'm on board and I kind of have an idea of the type that I need to go buy. How do I hone in on how much I need? What's the correct amount?
You just need a good general rule of thumb, because that seems like that's all you need in financial life is just to say something like, hey, why don't you just do 10 times your income? That ought to be enough. Is that perfect?
Well, it's not perfect, but it's a good start, right? If you're someone who's just starting out and you're trying to figure out what's a loose benchmark that I can use, 10 times your annual income is a great place to start. And often for young people, that's a great starting point. But when it comes to your true insurable need, we think that a specified approach for your unique situation makes sense. And when we say specified approach, there are a number of different factors that we want you to consider, a number of different things we want you to think. And here's the first one. How much do you spend? Notice we say spend, not how much do you earn, because what we really want to care about is if you were no longer here to provide for the well-being of your family or loved ones, you want to make sure that the income that you generate that is going out in consumption can be replaced. So that's sort of the lowest level, is how much does my family spend? And if I were no longer here to generate income to produce that, how much insurance will I need to be able to replace my income for?
Well, and there's so many, because there's different facets that will come with this, like how much you spend, but also how young or how your age is. Because if you think about this, if you have a young family and you probably haven't had enough time to build financial independence on your own. So if you passed away prematurely, you might actually need enough assets to cover 30 years worth of expenses. I mean, that's an important thing. So 10 times income is not going to necessarily carry the water as far as you need. So you definitely need to take into account how far you are from retirement and what resources you need to sustain that. And then here's another thing. What are some of these obligations you feel that you want to provide, like educational expenses? That's a super important thing, especially if you want to make sure that you're leaving the planet prematurely doesn't disrupt some of those powerful goals.
Yeah, so you go through how much you spend, your current living expenditure, education expenses. How about debts you want to pay off? Maybe if you were no longer here, you'd want that mortgage to be satisfied. You want the auto payments to be satisfied. You want the student loans to be satisfied. These are all dollar amounts that you would add up when you're kind of factoring in how much insurance do I need?
Now, all three of those make us sound like life insurance salesmen, because they all increased how much life insurance you need. Because like I said, you need, if you're replacing income, educational expenses, debts, every one of those things is going to go in the plus column. You're going to add all those needs up. Let's talk about things that could actually bring down your need for life insurance. The first thing is, how about your current coverage? There's more than likely you either have some, life insurance through your work. Your employer gives you $50,000 a year, or you bought a policy back when you were 25 years old. You can use that to lower the amount of outstanding life insurance that you might need.
And then the other thing that you can factor in is your current assets that could satisfy part of that need. So one of the things that we're all doing in the accumulation phase is we're trying to build up our pot of assets. Well, as our pot of assets gets larger and larger, the insurable need that we have gets smaller and smaller. So if you have a large portfolio that could replace some portion of your income, then you don't need as much life insurance.
I do want to add one thing that I think could be really important, because a lot of people need to hear this. We don't have all of our kids at once.
That's right.
I mean, Bo, you're a perfect example of this.
I mean,
well, no, I have a niece and nephew that are twins, and they were one and done, and that was it. That's probably a very, traumatic or scary way to do the child rearing in the beginning, but then it's probably a lot easier later on. But most of us spread our children out. There's nothing wrong with you doing life insurance over time as well, because you don't have to do it all at once. You could actually, maybe in your mid-20s, you have your first child. When you're 30 or 28 or 30, you could layer, since every time you have a new child, you have a new educational goal, you can layer additional insurance on top of each other. Think about when I was 25 or 28 when I had my first child, my income was here. But when I had my second child in my early 30s, my wife having the child, it was our need was completely different because my income was at a different place. I could also reestablish the new baseline for how much I need. There's nothing wrong with creating a laddered strategy for your life insurance needs
and
too.
So what ends up happening is you kind of factor this capital need. How much insurance do I need right now today? And then you figure out, okay, well, it kind of decreases through time. Every year that I don't die, I need slightly less insurance, assuming I'm doing all the other things I'm supposed to be doing from a financial planning standpoint. So what you recognize is, okay, I have this life insurance need that ideally will decrease through time until eventually I'm fully self-insured. That happens on one axis. On the other axis, I have my portfolio assets that are growing, and then I have my current insurance in place, and then I have to figure out, okay, where's my shortfall? How much additional insurance do I need to make sure that I have that capital need covered? And this also answers the question for how long do I need it? Do I need a 10-year policy? Do I need a 20-year policy? Just like you said, Brian, it's not uncommon for us to stagger. When we start out and we have that first kid in our 20s, we get a 20-year policy. Then we have another kid, we get another 20-year policy. But then we get older and we don't have any more kids, but the life circumstance changed. Maybe we need a 10-year policy. And then policies fall off, and then the other policy falls off. You can actually build through time based on your capital need an insurance ladder that accumulates and decumulates with your insurance need.
Now, I came close to saying, but I didn't because it's not my favorite thing to do as a financial advisor. It's much more fun to talk about retirement plans and structure because end-of-life planning is always the hardest. The only thing worse than life insurance is probably doing the full estate plan and the flow charts and all that. But needless to say, this is still such a super important thing, and this is exactly the type of stuff that a good financial advisor will do for you to kind of help you figure out what do you need in your life, because we're just like we all have different fingerprints, or you hear snowflakes are all different. Your financial need for both retirement as well as for life insurance and all the other components of your financial life are going to be unique to what your situation is and all the factors, all the variable, all the facets. So that's why we tell you, if you have learned, applied, grew to a point that you have a level of success, it might be time to take the relationship to the next level and fulfill the abundance cycle. And that's why if you'll go to moneyguy.com, we do have a work with us section. And this is the graph that we showed is something that we kind of took a screenshot off of the same tools we use for our financial planning clients. So that way you can work with your life insurance agent, with your financial planner, with your CPA, and any of your other advisors, and we can figure out the perfect situation for your needs.
Okay, Brian, so we've talked about why we need life insurance. We've talked about the different types, talked about how much we need, and we've sort of already admitted that we love term insurance. Like if you ask for our bias, we really like term insurance, which suggests that there is an insurance coverage in place for a period of time and then it goes away. Well, the fact that it goes away might suggest that there's a period of time where we don't need life insurance. And so we want to talk about when are the times that you actually don't need life insurance? When are the stages in life where that's not something you need? I'll go first, right? We've already said that you have an insurable need on your life when there are other people that depend on you. Well, for most of us, when we are young, when we're starting out in our careers, we don't have a spouse, we don't have debts, we don't have any kids. There aren't people depending on us. So I would argue that early on in your life, early on in your adult life, you probably don't need to go out and buy life insurance. When you're thinking about your financial order of operations and do I put money into my Roth IRA or do I go out and buy some life insurance? I would argue that for young people with no obligations and no one depending on them, that Roth IRA is probably going to be more valuable than going out and get a life insurance policy in place.
Well, without a doubt. I definitely think that this is one of those things that's driven by when is someone counting on you, and you're worried about unfulfilled obligations being funded. I mean, that's the biggest thing. As soon as I got married and we took on debt, I was like, wow, there's a risk, because I don't want to leave my wife with this mortgage. And then the next is once we started having children, I was like, man, whoa, we just bumped up the need much more. And then I'll even say it because my family history on medical stuff is not perfect. So as I got into my 30s and I was still very healthy, I started extending out. Instead of looking at 20-year term, I started thinking about 30-year term, because insurability is something that you should take into account, because especially when you're going down the term path, is because you're not guaranteed that when you're in your 40s or 50s that you're going to be in the perfect health to keep extending out that. But without a doubt, I do think you'll get to a point now, and I'm right here right now.
Sure.
Because you know, I started buying policies when I was in my 20s, and here I am somehow right around that big 5-0, and these policies that I bought back with 20-year terms have started going away.
Yep, started falling off.
And that's because, and fortunately, it's worked like a dream in the fact that in the background, over those 2 decades, I was building up my own personal assets, my own financial foundation, and now I am letting policies go away. And we actually have a chart, because this is the way it works with our clients too. Just like we showed you, there's that declining need. This is the total capital needs of where we're the unfulfilled financial promises we're trying to replace. They will be going down as you have the counterweight of your own assets building up in the background. And it's kind of nice when you do cross those intersection points that you have enough to self-insure yourself.
And once you get to that point, you have a decision to make. You can either cancel the policy, stop paying for it, allow it to go away, or in this illustration we have on the screen, you can see that the portfolio assets cross the capital need right around the age of 50. Well, there's still a life insurance term policy in place that looks like it goes out till about 51. We would argue in this scenario, this client could either cancel the policy, or more likely, since they bought the policy likely 20 years ago, it's super inexpensive, continue to pay it out until term. You get to make that choice once you're self-insured, because you want to have the insurance in place, not because you have to. It's like most things in your financial life. When you build up to a certain level of financial security, you get to make decisions around preference, not just around necessity.
Yeah, I'm glad you drew attention to that, because it is something I always try to talk to clients about, is just because you've now reached the financial independence threshold doesn't mean you just cancel those life insurance, because there's a good chance there's actually some value. Remember, with term policies, you set these policies up 20, even 30 years ago, and potentially you couldn't underwrite where you are now because you're older. So so there's probably more than likely you're paying a lot less annually than the cost of the insurance actually is. So to just throw away this policy, be careful with that. It's definitely one of those measure twice, cut once. Look at your financial life. If it's a small amount of a premium payment for a large coverage, it might be something that you just kind of let run in the background until it gets to the point that the renewal period is so much, you start paying the annual cost of insurance and it's astronomically high, that's when you actually let it go. But while it's in the lower flat premium period, it might make sense to kind of let that run its course. But this is once again one of those heavy lifting moments where maybe that's where you take the relationship to the next level, is because it is a heavy decision to make sure you're not having a blind spot or skipping a step and you get away from a policy prematurely or you do something wrong.
Yeah, look, life insurance is not fun. Like we get fun and it's exciting talking about Roth IRAs and 401ks and building the financial independence. Buying life insurance isn't something super fun because it's something we buy that we hope we never, ever have to use. So in our opinion, it makes sense to go with the most effective and cost-effective means of getting it in place, getting term coverage in place to satisfy your insurable need, and then move on to the rest of your wealth building journey. But it is so important, Brian. We've both been there. We've lost loved ones and we've been Advisors to clients who've lost loved ones, when that life insurance policy that paid out, it was the lifeline. It was the thing that stepped in to help bridge a gap from a very difficult stage in life. So it's not something you need to neglect. Don't be someone in that 37% of folks who have young kids in the house that does not have adequate and appropriate life insurance coverage. Do it, knock it out, get it in place, and then move on with the rest of your wealth building journey.
Yeah, this is one of those things where it's a topic, we hit this pretty hard, hit this fairly fast. There's a lot of variables and a lot of things we could have gone different roads to discuss, but hopefully it has now opened the door for you to have your own discussion and self-analysis. What do I actually need for my family? Because that is the biggest thing, is we want this content to educate you, take your financial situation to the next level. And look, we have a whole page of resources. If you go to moneyguy.com/resources, tons of free stuff. You owe it yourself just to go spend some time looking at all the free stuff we give out to our listeners. And then look, if you get there and you're like, man, this is good, but I'm realizing I need to streamline. I need to accelerate my success. I want you to go check out learn.moneyguy.com. We actually have courses that will accelerate your success, take you to financial independence that much faster. I'm your host, Brian Preston, Mr. Bo Hansen, Money Guy team, out.